Hi there, this is Dr. Sani Garas. In this video, we are going to start working on the audit procedure for different cycles. But just to make a quick review on the topics we covered to know the relation between the topic I'm going to present in this video and the prior presentations, that in the beginning of the audit, the auditor has to develop an understanding about the client and make an engagement letter. Based on that, the auditor has to understand the industry of the client and the risk of material misstatement. Once the auditor assesses the risk, then he has to visit the client to see the internal control and whether the compliant is following COSO framework or another framework on the internal control. And the auditor will start to collect some evidence, assuming the control is good and he's going to make test of control, or the control is poor and he has to do substantive procedures. How the auditor is going to collect the evidence, he has to develop sampling, and this is what we discussed in the previous chapter, whether we make a statistical sample or non-statistical sample. And we have seen different ways of selecting the right sample to avoid the sampling risk. And now the auditor has to start auditing the cash cycle, then revenue cycle, then expenditure cycle, then HR cycle, and so on. For the cycles, there is no auditing standard. So when you see the material I uploaded for this week, there is no standard from PCAOB or AICPA because these are procedures are developed by the auditors. The regulators leave it for the auditor to choose the procedures that he feels comfortable with. But the point is the auditor has to keep in mind to select the right evidence to validate his reason about the audit of these cycles. So with this in mind, let us take a look on the different points that we need to be aware in auditing the cash cycle. So in this chapter, we will talk about what are the types of cash accounts and financial instruments like derivatives. Then we will talk about how to manage the cash to minimize the paperwork, to expedite the collection, and to automate the transactions. Then we will go through the auditing of the cash cycle. Then we see the relation between the cash cycle and the other cycles. And this can increase the importance of the cash cycle when we see how the cash is integrated in the other cycles. We start to give some importance to the cash. Then we talk about the audit test as approved for cash and financial instrument accounts. So what are the cash accounts and the financial instrument accounts? First, we have the general cash account. The general cash account has virtually all the cash receipts and disbursement. And this cash account shows all the key transactions in and out from the cash. But we have also the bank accounts. And here I call it branch bank accounts because you might have multiple accounts from different banks. All of the big corporations, they have more than one bank account. So for each bank account, we call it branch bank account. Then we create one account only for the payment of cash for the payroll, especially if the company has a lot of employees. And we have another cash account for incidental expenses or miscellaneous expenses that has small amounts. We say we don't need to overload the general cash account with the small expenses. So we put all the small expenses in one account, and then we make one journal entry at the end of the month or quarter, and then we pass it on to the general cash account. And then we have accounts for the derivatives, the marketable securities, and hedging activities. This figure here, it shows you the flow in and out from the general cash account here. From where the general cash account get the cash in, it's either from the bank or the derivatives and the financial instrument, the cash equivalent. And where the cash account spend the money, it's either on the payroll or the petty cash. And the balance between the in and out, it goes to the cash in the balance sheet. So this is mainly the movement of cash in and out. Now, how can we manage the cash? We need to keep in mind that the cash, it's a very risky asset. And because of that, we need to minimize the human interference with the cash. So we need to automate the cash. Plus, we have lots of transactions that happen on the cash every day. So we need to give access to the bank to collect the cash on our behalf, put it in our account, and get interest on that cash. Good way that we can do it for managing the cash is the lockbox. What do we mean by lockbox? It's a mailbox where the bank in each region or each state can have access to this lockbox where the customer deposit their checks into the lockbox and the bank employees, they go and they open the lockbox twice a week or 3 times a week. They get the checks, put it in the cash account for the company. The lockbox can save the time and the efficiency of cash collection by putting the checks immediately into the client's account. So the lockbox will save the mailing time and will minimize the human error because the lockbox is opened by the bank employees, not the company's employees. Also, instead of making the payment by checks, we can use EFT, electronic fund transfer, where the transfer goes from one bank to another. And this will minimize also the human interference with the cash payment and make the time efficient for the payment. The compensating balance, we need to maintain the minimum amount of cash in each bank account to avoid the bank penalty. Most of the banks, they require the companies to leave a certain amount as a compensating balance in the account. If the balance go below the minimum requirement, the company has to pay interest to the bank. So we need to keep an eye on the bank account to make sure that we maintain the compensating balance. Finally, we make agreement with financial institution so they can control the cash on behalf of the company. And this, as I said, it will accelerate the cash collection, reduce the human error, and hopefully eliminate the fraud. And these are the main benefits from the cash management, is to speed up the collection, reduce the amount of paperwork, and automate the cash management to eliminate any fraudulent act that might happen with the employees. The audit of the cash here, it has main goals. First, we need to assess the inherent risk in the cash and including the fraud risk and other control risk. And I'm going to discuss it in details in the coming slide. So remember, one of our goals when we audit the cash is to make sure that the company is able to meet or control the inherent risk and the fraud risk. The other one is we need to test the management assertions for the control of cash. So when we make audit for the cash account, we need to keep those 2 items in mind. First, let us talk about the inherent risk in the coming slide, and then we talk about the management assertions in the following slide. So what are the reasons that might increase the inherent risk? Number one, there is lots of transactions that might happen on the cash every day. And because of the high volume of activities that might happen to the cash, there is an exposure for the employees to get access to the cash and they can keep the cash for their benefit. So the volume of activities might increase the inherent risk. We need to check that the company has good control to minimize the human interference with the cash movement. Second, the liquidity. The cash is the most liquid asset that the people can control and transfer into another asset. And this is the reason If the company or the employees, they have access to the cash, this will make the inherent risk very high. And we need to check the types of controls the company is making on the cash. The automated system also, we need to check if the company has lockbox and use EFT or not, because the more the automation that might happen on the cash transaction, the less inherent risk that might happen. Also, we need to check that the company has enough cash to meet the debt covenants, like paying the interest to the debtors and to the banks. And finally, the cash can easily manipulate it by stealing the actual cash and making cover-up journal entries. The second point, that when we audit the cash, we need to make sure that the management is able to maintain the management assertions for each transaction of the cash. So on the date of the balance sheet, we need to make sure that the cash exists. How can we do that? We, as an auditors, we go and count the cash physically. So we check the cash in the cash vault, we check the cash in the imprest account, and with the petty cash account to make sure that the actual cash on hand is equal to the cash balance on the balance sheet, and this will maintain the existence assertion. We need to check that the cash has been recorded in the journal entry and goes through the accounting cycle, and this is what we call it completeness. So the cash balance include all the transaction that has been occurred in the period, has been recorded in the journal entry, general ledger, trial balance, and so on. The third one, we need to check that the actual cash in the company belongs to the company, not to somebody else. And this is what we mean by rights and obligation, that the cash in the hand of the company now, it's the company's cash. Otherwise, the company can borrow the cash from somebody else and control it, and this will make dressing for the financial statements, but it's not the cash for the company. Valuation and allocation, we need to check that the recorded balance reflect the underlying economic value of the assets, that the company records the cash in the actual value of the cash. And what does it mean? If the company has short-term financial investment like government securities, they might record it at the cash balance, but remember that those governmental securities, they have a small interest. The company has to record it in the balance sheet, and this will make the right valuation of the cash on the financial statement date. Finally, the cash is properly classified in the balance sheet, whether in the current assets or long-term assets. And you might wonder, how can be the cash recorded as a long-term assets if the company doesn't get access to the cash until certain point in the future? It has to be recorded in the fixed assets. So when we make the audit for the cash, we have to keep in mind the control that has been made by the company to reduce the inherent risk, and the company is able to meet all the management assertions. The relationship of the cash to the business cycle will show us the importance of the cash to the other cycles. So assume here is the main cash account. We need to know which cycle is feeding the cash and which cycle is taking the cash to maintain the needs of the company. First of all, the cash in comes from the capital acquisition by issuing either stock or bonds. So when we issue stock, we generate cash, which feeds the cash account. When we pay dividends to the shareholders, we take it from the cash, which will reduce the cash balance. Also sales, whether we make cash sales, as you can see here, or we make credit sales, those two items, they feed the cash account. And where we pay the cash, we pay it to the accounts payable, we pay it to the payroll, we pay it to the tax deductions, and any other expenses. So this can tell you when we audit the cash indirectly, we are auditing a small portion of the accounts from the other cycles, which we will discuss it in the coming chapters. So as I said, the relation between the cash and the other cycle, it helps us to understand the transaction cycles. It shows the importance of the audit test to the other cycle. Now, the audit test for the cash, it happens on the bank reconciliation. I am sure you might cover the bank reconciliation in intermediate accounting class, but in this course of audit, we need to see how we audit the bank reconciliation, because during the last 2 weeks of the year and the first 2 weeks of the coming year, the company can make some transactions between the company's book and the bank accounts, which can create fraudulent act and misplacement of the cash balance. How can we discover it? By checking the bank reconciliation for December and January and make sure that the accounts are recorded properly. How we make the bank reconciliation? We usually get the bank balance, we add deposit in transit, subtract outstanding checks, and then add or subtract any error. What do we mean by deposit in transit? The cash that has been went to be collected by the bank, but it's not actually collected, it's in transit. The outstanding checks is the checks that we have written to the supplier or the accounts payable, but the supplier has not cashed that check yet. And then for the book balance, we add notes receivable collected by the bank, we subtract non-sufficient fund, NSF or bounced check, and subtract the check printing or any bank charges and any error. What do we mean by notes collected by the bank? Sometimes we give the notes receivable to the bank, and in the right time, the bank will go on our behalf to collect the notes receivable from the client. The NSF, sometimes we get a check from the client, which we deposit to the bank. And since we deposit the check on the bank, we add it to our books. But maybe 2 weeks later, we find the check is coming back to us, claiming that the client doesn't have enough fund in his account. So the bank doesn't record the check. So we have to subtract it from our book balance, and we call it not sufficient fund or bounced checks. Any services have been made by the bank for the company has also to be subtracted. And by doing this, the balance we get from the bank should and must be equal to our balance. And this is the key goal of the bank reconciliation. As you can see here, here is the bank balance. We add the deposit in transit, and then we subtract the outstanding checks, and we get the book balance here. We add, you see all the bank charges, we subtracted, not sufficient fund, and here we subtracted. And at the end, we get the bank balance here equal to our book balance. So here we make this draft or this table where we can see here the balance plus all the deposits minus all the checks, we get the ending balance. And if we add here the beginning balance plus deposits minus checks, it must give us the bank balance. And I'm going to show you now 2 different exercises where we can work on it to make sure that when we do this calculation at the end, it will be right. So first of all, we need to get the bank statement. As you can see here, we get from the bank statement the balance, deposit, checks, and the final balance. Those 4 numbers, they come from the bank statement. And then we take each section individually. So now let us look at this section here. The balance here, where we get the bank balance, any deposit in transit that happened last month or last year will be added here. And any outstanding checks from the last year, it will be subtracted here. And the bank, excuse me, from the service charge will be added, and this will give us the final balance. Excuse me. For the deposit here from the bank, but since we added the bank balance here, we added the deposit, we don't need to add it in the deposit here. It was already included in the beginning balance. So we subtracted from here. But the new deposit in transit, we added in this section, and also we added at the final. And the same thing here. Since we subtracted the outstanding checks here, so we subtracted also here. And the outstanding checks, the new one, we put it in the checks here, and then we subtracted. Because if you remember in the previous slide, I say we get the beginning balance plus deposit in transit minus outstanding checks, and then minus any service charges. Since we put it by minus here, so we put it plus just to cross off each other. And then we put here the deposit. As I said, we get the deposit, we subtract the old one, add the new one, and here there is an NSF. So we put it here by minus, and here also we put it by minus to remove it from the checks. And by doing that, we add the beginning balance plus deposit in transit minus all the payment, we get the ending balance. So let us look at two different exercises on a hope that it will show you how to do it. So when you see something in the assignment, you will be able to do it. So here is the first exercise. So in this exercise, this is what's been given, and this is the answer. So here in the exercise, you see the four balances are coming here from the bank statement, which I put it here. It's the same. There is no difference between them. And then we start. As I showed you in the presentation, this old balance has been made. So we don't put it here. In the exercise, it was put here. No, if you remember from the slide, we say, since this balance has been added to the beginning, I should subtract it from my new deposit, because this is old deposit and not new. The new deposit, I put it here, and I also put it here, because I get the balance plus deposit in transit. For the outstanding, we put it here by minus, and here I put it as a new amount, but the right thing should be, I should subtract it here. And remember, this is the old outstanding. For the new outstanding, here is the subtraction, but here it will be subtracted as well. But in the example, remember what I am showing to you here is the example, and this one is the answer. So when you check the answer here, first we add the old one, but subtracted from the new deposit. The new deposit here, I put it here, and then I add it to the balance. The old one, I subtracted from the balance and subtracted from here. But the new outstanding checks, I put it here by plus, and then I put it here by minus. So as I showed you in the previous slide, that we start by the beginning balance, and then we add the new deposit in transit, subtract the outstanding checks. What might make you confusing is here there are two amounts for the deposit in transit and two amounts for the outstanding. The first one, it goes to the old balance. The second one, it goes to the new balance. Here also the same, the outstanding, the first one goes to the old balance, the second one goes to the new balance. For the bank service charges, here it will be plus, and also it will be plus because this is old one. But for the new one, I put it here by minus, and here I put it as a plus. And finally, the notes receivable collection, it should be minus here and minus here because this is from our book balance. We put it here just to get the right amount. And then the NSF, we put it here by plus, but here also minus. And then if we add this one, the beginning balance plus all the deposit minus all the payment, it must give me the final amount. So this one, it's not coming normally, it's not coming by itself. It's actually the result of the calculation from here. The balance plus deposit minus payment, it will give me the final balance. And this is what we do it in auditing. Let us take another look on a different example. So here, example 2. Here is the example, and here is the answer. Of course, if I'm in your place, I'm going to hold up my video, take a look on the screen, get a piece of paper and try to do it yourself, and then you can look at the model answer. But again, I'm going to repeat the same hints. First of all, we get these 4 amounts from the bank statement. So I don't change them because it's written in the bank statement. We have the deposit in transit, old and new, and the outstanding checks, old and new. For the old one, I have to remove them because they are already included in the bank statement. For the new one, I add them. So I get the beginning balance from the bank plus the new deposit in transit minus the outstanding check plus all the bank service charges minus any NSF, and then we get the amount. And as you can see here, there are some difference that has been given in the example here. My job is to remove all those differences when you change the signal of the different numbers. So here you see this one, it's plus, and here minus. No, it should be here and here minus. So what I did, I shift this number, I put it here. The same thing here, I put it for this one, it's minus, and here plus. No, it's minus here, and here it should be minus. In the same way, here it's minus, plus, it should be plus, minus, and so on. And by doing this, we remove all the errors that have been made by the accountant. And as I said, if I add the beginning balance plus deposit minus a checks payment, we have to get the ending balance. I hope you find this presentation useful, that give you the basics of the cash accounts, how to do auditing on the bank reconciliation, and I will continue talking about the fraud that might happen on the cash in the coming video. Thank you so much. Bye.